S. Calculate the marginal cost of capital. Marginal cost of capital, MCC, represents the cost of raising one additional dollar of new capital. It reflects current market conditions rather than past financing terms. MCC may increase as more capital is raised. Higher borrowing may lead to increased interest rates due to rising financial risk. Breakpoints occur when the cost of a financing component changes. For example, retained earnings may be exhausted, requiring issuance of new equity at higher cost. The MCC schedule helps determine the optimal investment budget. Projects are accepted until their return equals the marginal cost of capital. Understanding MCC supports dynamic capital budgeting decisions. T. Explain the importance of using marginal cost instead of historical cost. Historical cost reflects past financing decisions and may not represent current market conditions. Using it in decision-making can lead to incorrect investment evaluations. Marginal cost reflects the opportunity cost of new capital. It aligns project evaluation with current investor return expectations. Investment decisions are forward-looking. Therefore, they should be based on expected future costs rather than past contractual rates. Using marginal cost ensures accurate comparison between project returns and financing costs. Applying marginal rather than historical cost improves capital allocation efficiency and supports value-maximizing decisions. U. Demonstrate understanding of the use of the cost of capital in capital investment decisions. The cost of capital serves as the required rate of return, hurdle rate, in capital budgeting. It is used as the discount rate when calculating net present value, NPV, and as a benchmark when evaluating internal rate of return, IRR. Projects that generate returns above the cost of capital increase shareholder value. WACC is appropriate for projects with risk similar to existing operations. Riskier projects require a higher discount rate, while less risky projects require a lower one. Using an incorrect cost of capital leads to poor decisions. Underestimating it may cause acceptance of value-destroying projects. Overestimating may reject profitable ones. Cost of capital links financing decisions with investment evaluation. It ensures alignment between risk, return, and strategic objectives. Proper application promotes efficient capital allocation and long-term value creation. 5. Demonstrate understanding of how income taxes impact capital structure and capital investment decisions. Interest payments on debt are tax-deductible, creating a tax shield. This lowers the effective cost of debt and encourages the use of leverage in capital structure decisions. Equity financing does not provide a tax deduction for dividends. Therefore, debt financing can reduce overall cost of capital, all else equal. In capital budgeting, cash flows must be evaluated on an after-tax basis. Depreciation provides tax savings, affecting project NPV and IRR. Tax rates influence investment attractiveness. Higher tax rates increase the value of the interest tax shield but may also affect net project returns. Optimal capital structure balances tax benefits with increased financial risk and potential bankruptcy costs. W. Use the constant growth dividend discount model and understand the two-stage model. The constant growth dividend discount model, Gordon growth model, values stock as price equals D/R minus G, where D is next year's dividend, R is required return, and G is constant growth rate. The model assumes perpetual, stable dividend growth. It is most appropriate for mature companies with predictable earnings and payout patterns. The two-stage dividend model applies when growth is not constant. It estimates high growth for an initial period, followed by stable growth thereafter. Valuation requires discounting both near-term dividends and terminal value. Understanding these models supports equity valuation and cost of equity estimation decisions. X. Demonstrate understanding of relative, comparable, valuation methods. Relative valuation compares a company's market multiples to those of similar firms. Common ratios include price/earnings, PE, market to book, and price/sales ratios. PE ratio reflects how much investors are willing to pay per dollar of earnings. Higher ratios may indicate growth expectations or lower risk. Market to book ratio compares market value to accounting book value. It reflects investor expectations beyond recorded assets. Price/sales ratio is useful when earnings are volatile or negative. It focuses on revenue generation ability. Comparable valuation is simple and widely used but depends heavily on selecting appropriate peer companies and market conditions.